So, Ryan, would you agree that, as Mark says, we'll continue to see the data, but perhaps everything is going to be okay and the markets will get a cut by the end of the year?
Well, Vonnie, yesterday was very confusing with Mr. Powell, because saying that they are data dependent and then acting not so much as data dependent is very confusing. Yesterday, let's invent a new word, hawkish dovishness or dovish hawkishness, I don't know. What I think the Fed is in today is in limbo. It's too early to cut rates and it's too late to hike rates. This is exactly where the Fed is. It's quite confusing.
They didn't sound so confused, though. The Fed chair seemed very confident that they are on the right path, that inflation is coming down, that this might be a temporary blip in ECI or what have you, but that everything is under control.
Well, this is the message he conveyed, and I agree with you, a lot of confidence, but this has reflected relatively poorly on markets. Markets jumped immediately above 1%, and then they closed mostly in the red at the end. So when you look at the numbers, look at the ISM prices paid. It's at 60, the highest since June 2022. If you look at ISM New Orders, it's below 50, contractionary. Look at ISM employment, it's below 50, it's contractionary. Look at core, super core, it's going up. Inflation seems to be coming back. We are heading to a potential stagflation scenario. I agree with Jamie Dimon when he said there's more than 50% chance of stagflation. I agree with that.
The Fed chair said that monetary policy is restrictive and that it's restrictive enough now, that it's sufficiently restrictive. You're shaking your head. Why not?
Absolutely not restrictive. Look at financial conditions. They're very, very easy. Look at financial markets. Look at stock markets. Financial conditions are very easy. Add to that, 2 days ago, Mrs. Yellen announced that there will be Treasury buybacks. This is expansionary. Look at fiscal spending. Finally, they were tapering the QT from 60 billion a month to 25 billion a month. This is huge. This is massive. This is very much expansionary. This is not restrictive at all.
I know that you have the feeling that the election will have something to do with it, but Fed Chair Jay Powell very specifically said, and you almost got annoyed, the election is not going to interfere with what we do. We are completely independent, apolitical. We have nothing to do with the election. We will hike in whatever month we want to hike.
He has to say that.
Or cut.
He's a professional. He has to say that. All around the world, US, Europe, China, Japan, everywhere in the world, there is political intervention with fiscal and monetary policies. This is unavoidable because these answer to the political leaders of the country. So there is influence in a way or another. We've seen this with Mr. Trump, and today we're seeing it in a much more subtle way.
I want to ask you a little bit about China, because we are seeing HS Tech rally substantially today and over the last few sessions. And I was just looking, you know, we're up about 20% since the beginning of the year. That in the past, or at least in the last couple of years, has tended to be relatively short-lived. So macro tourism, you know, is a word Julie Wren, our columnist, uses for it. Is this sustainable?
We were very nervous about China late 2023, then decided early 2024 to come in again. And when we met 1 month ago, this is when we really started going in full on. HSI Hang Seng was at 16,600. Today it's 18,155. So that's a very nice jump since. What we're doing is we're booking profits, resetting positions, booking profits, resetting positions. So we're doing it in a very gradual way to avoid, as you rightly mentioned, a turnaround of China, Chinese equities. But we do think this could be sustainable. Growth has surprised to the upside. Manufacturing is coming back quite clearly. What we're worried about is Europe, US tariffs and imports from China, though we think US and Europe, they need China because they need to import deflation. They need to reduce inflation by importing deflation from China, lower manufacturing costs.
So when you say you're resetting positions, are you changing industries in China, or are you moving, you know, to different types of asset classes?
So we're booking profits quite regularly. Every time there's a jump, a nice jump, we book profits and then we reset positions. And absolutely, we're doing a lot of stock picking, a lot of very detailed work in picking the right companies, the right industries. Try to go into dividend paying, go into nice jumps in certain stocks like EVs, for example, where several companies today have performed very well.
On gold, we spoke about this last time as well. Geopolitical tensions really sent it to records, and then it just started coming off. It's almost like suddenly there was no concern about geopolitical issues whatsoever. Is this pullback in gold warranted?
Absolutely. Every pullback in gold is an opportunity to buy, and we will see more pullbacks. Every single pullback is an opportunity to buy. This is our recommendation to our clients. Let's not forget, this whole jump is coming from central banks. In 2022, 2023, there were record amounts of gold bought by central banks around the world. More than 1,000 tons bought in 2022 and slightly less in 2023. This is absolutely massive compared to what we've seen in previous years.
So this is consistent with your view on inflation and the fact that the Fed might be behind the eight ball, if you like. What happens if that part of your thesis is wrong? Is your gold thesis then also wrong?
Well, we will continue buying gold because we think that the East now is buying gold to support their currencies. Sovereign debt has reached very high levels across the world, and the only way for central banks to hedge and protect their currencies is by buying gold. Gold now should be part of any asset allocation in decent amounts.